Welcome, hello and welcome to today's webinar, Budgets and Budget Development. This is the second of three workshops in a series called Taking the Fear Out of Nonprofit Finance and Risk Management, brought to you by the South Saskatchewan Community Foundation and the University of Regina's Community Engagement and Research Center. I see a lot of familiar names joining us today, so I know many of you joined us on March 30th for the first session on the fundamentals of financial statements and accounting. If not, don't worry, I'll post a link in a few minutes into our chat to our the website, which has a link to the recording of that particular session, as well as the slides that our presenter kind of worked from last time. Now, we know there are people joining us from a diverse range of organizations and communities from across Canada, Saskatchewan, but across Canada, in fact. So if you have a second, please take a moment to introduce yourself to the wider group in the chat with your name, where you live, and what organization you're with, if you can. Now, for those of you I haven't met yet, my name is Lynn Gidluck, and I have the privilege of leading the Community Engagement and Research Center. I think joining us today is Karen Henders from the South Saskatchewan Community Foundation. Karen is Director of Community and Grant Stewardship for the South Saskatchewan Community Foundation. Now, we're so excited to have so many people joining us from sectors.
Playing around, you're on mute here.
Oh, I'm going to put somebody on mute here. Everybody can take a moment and put themselves on mute if they can. Now, we recognize that many of the people joining us for these sessions work for organizations that don't have a budget to offer professional development for their staff and volunteers. And it seems like I'm always begging, borrowing, and stealing money for my kind of dismal budget at the university. So I'm extremely grateful to the South Saskatchewan Community Foundation for their sponsorship of this session and others that we will be providing throughout the years. Now, I am pleased to introduce you to Dave Rozell. Dave is Executive Vice President of Finance and Administration for CAA Saskatchewan. He's also a regular instructor for the Hill School of Business at the University of Regina, as well as Sask Polytechnic. However, Dave is not only an expert in accounting and all things financial, he really does have a deep knowledge, appreciation, and understanding of the challenges that people working in the nonprofit sector, and for agencies that just don't have big budgets and big teams of people to do the financial kind of stuff. So we really have like a real gratitude for him for doing this. I'd also like to do a shout out to the person who told me about Dave, who is a professor at the University of Regina, Bruce Anderson. So anyways, before I begin and hand over the session to Dave, though, I just want to quickly acknowledge that although this workshop is taking place online and we have people coming across the country to join us, the South Saskatchewan Community Foundation and the Community Engagement and Research Center have physical homes on the Treaty 4, the traditional territories of the Cree, Saulteaux, Nakota, Dakota, and Lakota First Nations, and the traditional homeland of the Métis. Many of the organizations that we serve through the Community Engagement and Research Center are working really hard, like we're trying to do, to acknowledge the harms and mistakes of the past, and so that we can all work for a better future together with the work that we do with communities. So I'm just going to pass this over now to Dave. At the end of the session, Dave promised, like last time, that he would forward me a copy of his slides. So that will all be coming to you at some point in perhaps the day, or if the day kind of doesn't get ahead of me, either today or tomorrow. So take it away, Dave.
Okay, let me share my screen here. Just a minute, I shared the wrong one. Okay, there we go. You should be seeing a blank screen that says budgets not and not for profits, hopefully. Okay. So basically what I want to start to do is just a bit of a continuation on what we did last week, or 2 weeks ago, I guess it was. And just talk now about the budget piece. When I showed you examples of statements last time, I did have a budget line in or a column in there and variance columns. So we'll kind of pick up where that leaves off today and where that left off today and work from there. So we'll start with just basically going through what it is. I think most of you are familiar with what this would be, and probably most of you know what you are doing in this. So I don't know that I'm going to give you a whole lot of new information today, but hopefully we can coalesce it a little bit into something that makes some sense in the next hour or so. But basically what you've got here is a document. Okay, it's a planning document, and it basically has two functions, and not always do people realize this when they're doing it. It is a planning document, and it is a control device as well. And you have to, when you're making your budgets, balance those two off usually. Okay, now where I'm going with that is that when you put numbers into a budget as at the planning side, you could plan on things happening that may or may not happen in the next year or two. And then that, of course, takes away from the control side because, for example, I could say that we're going to do something based on revenues coming in of X amount of dollars, and put a little bit of a stretch in that so that it incites people to actually go out and try and earn the money from donations or whatever it happens to be. But what the reality strikes, and all of a sudden we have something like COVID-19 comes along, or anything really, and the donations don't come in as much as we felt they would. So now the control side may or may not be as effective as it could have been because we've got this great big number in there for donations.
Hi, thank you.
And a great big number for donations. And at the end of the day, they're not going to materialize. So we end up describing variances all day. But still, you got to remember that this is a communication tool. It is a way of us looking at our organization into the future. And it is a way, once we've established and approved what the budget's going to be for any particular period, of looking at how we're doing. It gives us at least one milestone in terms of what we can do. So if we look at the planning side of this, is it actually makes us sit down once or twice a year and look at what we're actually going to do for the next time frame. And, you know, I don't know about you guys, but I know often I have to just sit back in my desk and say, wait a minute. We get lost in the minuity of trying to just run the place day to day. And, you know, I don't end up having to look for too many problems because usually there's a bazillion find me in any given day. So you end up getting lost in that whole almost the negative side of the business, for that lack of a better word, because you're dealing with things that went wrong. Okay. And you have to just sit back, take a deep breath and say, okay, wait a minute, you know, what are we actually accomplishing here? And what are we planning to do? And how are we going to get there? Okay. Now, again, the smaller the organization, the easier the communication part is. But, you know, Lynn didn't mention it, but I'm also a VP for CAA Saskatchewan and in the finance area. And we have 6 different business lines. So how do you think do we communicate with one another on what the different parts of the organization are actually doing? And when we actually sit down and do the budget as a whole, it's actually part of our strategic planning process. And I'll talk a little bit more about that in a few minutes. But basically that gives us an opportunity. Now, it's not that we don't talk to one another on a daily basis, we do. But as I said, often as not, we're dealing with something that went wrong. So when we get the opportunity to actually sit down and say, okay, what would we really like to do? Then we get this planning dimension coming into play, and it's more fun, in fact, to be truthful. You get to look at, you can start with, what would you do if you had a blank slate? And you can get to then, of course, whittle that down, and it focuses you a little bit in terms of where do you really want to take your organization and where is it going to go? And are we really doing what our board of directors has in mind for us to do in terms of what the actual reason for life, for lack of better words, of the organization? So before we go into the control dimension, are there any questions on this planning side? I think it's fairly straightforward, but if there are any questions, we'll pause for just a sec here. Lost my critter. There it is. Okay, the control side of this thing, basically what it talks about is the budget providing objectives for us to meet. And sometimes they're going to be a little bit stretch objectives, and sometimes they're not, okay? But, I have to deal with a bunch of operating people, and invariably, the budgets all flow through me to the CEO, and then, of course, to the board. But we have all the operating people, and I'm not going to, tell the operating people how they, well, I shouldn't say that. I will tell them how I think they should run their organization if I think they're doing it wrong. However, having said that, I'm not immersed in their day-to-day operations, and I'm not an expert in a lot of the things that they do. They pay me to do other things. So I can't really say, I have to deal with budgeting and planning from the point of view of what they do. However, what they usually do when they submit their budget is they make sure their expenses are well padded and their revenues are as low as they can possibly be. And the organization does have certain objectives that it wants to meet from terms of profitability on some of the areas that we have in our company. So usually it doesn't fly, and they have to go back and start over. Now, once we've got something agreed to that we can both live with, though, the control dimension basically says, okay, you didn't think you could make those revenue numbers at the beginning. So we've now agreed on a revenue number. You now have to meet it. Okay, so you're going to have to go out and get a little bit creative in terms of how you're going to get there. Now, like I said, I don't think I'm telling anybody anything that they don't already know. We deal with this on a day-to-day basis. The budget, once it's set by the board of directors or approved by the board of directors, is our operating document for the next year or so. And what we end up doing is saying, okay, well, we've agreed to this number. We have to try and figure out how we're going to get there. All right. However, it is a continuous improvement process. It's not meant to be something that is punitive. So even though there is a control dimension in here, it's meant more from the point of view of making sure making sure something in your organization is not escaping your attention. Because, as I said, when we look at this on a day-to-day basis, we spend time doing a lot of work with the squeaky wheels, and something could very easily slide in and not be noticed until it's too late. So that's basically what the control side of a budget is all about. And what we're really looking here to do from the control perspective is influence what people do. Okay, it's part of our responsibility as managers to make sure the organization of the people are doing what we want them to do. And I don't want to go down the road, but it's also part of the internal control process, which is also a process of making sure people are doing things the way we want them to be done. And it does give us some flags, for lack of anything better to say. It can flag, or it can indicate that something's not going quite how we wanted it to. And it can then also be something that says we need to do something different. So basically, that's the aspects of control of a budget. It's the dual nature of the beast. It's a planning document, which can make it actually be somewhat of a stretch to achieve, but it also has the control feature, because once it's been communicated that this is what we want to achieve, we want to try and find out if we're actually getting there. The other aspect of the control is if we have a number specific in place, that people are respecting that number and going from there. So are there any questions on what this animal actually is? The process that it goes through is illustrated here. I don't really want to, I'll spend a little bit of time on this slide, but that's basically what we're talking about. We have the planning process on the left here, and we have the control process on the right. So again, are there any questions at this point? Okay, now to talk a little bit about this process, just do the process of what the budget actually should be. And I'm just going to expand on the boxes a little bit here. The planning process is a loop. Okay, it's a feedback loop. We've all seen these things. And it all starts with a strategic plan. So you have some sort of a plan for what your organization is going to do. It revolves around, of course, what the organization is about and what they're for. But that's developed by management, and depending on the size of the organization, and also depending on the actual requirements of the board of directors, in consultation with or collaboratively with the board of directors. But the formal process is usually the strategic plan is developed by management in response to direction from the board, and then circles back to the board, and the board approves it. Now, once you've got that plan, it's going to have in it the things that are under there. Okay, it's going to have some long-term objectives of what you want the organization to do. Now, that could be longer, but it's usually a 3 to 5 year time frame. So where do we want this organization to be in 3 to 5 years? And it's going to have some shorter term, this year or maybe 2 years out. And you're going to end up with a short-term plan that actually goes through those short-term objectives that is a subset of the long-term objectives usually. And when you actually have that short-term plan, that's when you usually develop your budget. Now, the strategic plan will likely have a financial forecast in it for that whole 3 to 5 year period. Ours does, because we simply can't just simply put an idea into the strategic plan without some sort of a notion of how we're going to fund it and how we're going to actually come up with the idea. Now, there's no way it's cast in stone. Everybody's crystal ball is looking out 4 or 5 years. I don't know. I dropped my crystal ball down the stairs and broke it several years ago. So, I don't really say that I can say what's going on 4 or 5 years from now. I can tell you for sure 5 years ago, I would not have been sitting in my chair in my office and predicting that we would have a virus out there that would have kept parts of our organization locked down for a year. Okay. Now, that's a little bit more on the risk management side, which we'll deal with in the next seminar, but it was definitely not part of our strategic plan. And we just basically went through the process of going through this with our board last week, which is why there was a week in between these seminars, because I had to do that process. And we now have some long-term objectives. So the upper management of the organization is going to write out a plan, which will go back to our board of directors in June, and they'll approve it, change it, whatever they decide to do. Now, normally what happens is the strategic planning process would happen January to March, and it would have been approved at the board meeting last Friday. However, because of COVID-19, we put that on. And we're going to actually have to develop our budget and our strategic plan in parallel. Okay, so at the same time. But normally what's happening is the white boxes are going to happen first, and then you will develop your budget. Okay. Then once the budget is done, we will get feedback on what that budget is via the financial statement work in terms of what actually happens, feed that into the strategic plan as we bump it forward another year, go back down, do a new budget, get feedback, and start again. So is there any questions on the planning process side of the budget at this point? Okay, then on the other side, we've got the monitoring of the actual activity, which is the primary feedback loop for feeding into the planning process for the following year. So we compare the actual to what our plan was. And if I ever get my budget exactly identical to actual, that'll be the day I retire, because I won't be able to do anything more. But when we compare the actual with the plan, that is our feedback loop. I've drawn the arrow not so much from the comparison area, but after the investigation area, simply because usually the budget, the financial statement is going to tell you that there is a problem. It's not going to tell you what the problem is. You usually have to dig a little deeper to find out what is actually causing a number to not be what you'd planned it to be. So why are the revenues not where they're supposed to be, or why are they higher? And yes, you do need to know to find out why revenues are higher. It seems a little bit counterintuitive. If things are going well, you leave it alone, right? Well, yeah, you do. But you also want to know why it's higher than it was, so that the next time it's lower, you can actually apply the principles that have made it higher to see if you can get it back up again. So there is investigation involved. Once you've investigated something, now you've got the feedback loop for the strategic plan, because maybe you can do something about it and maybe you can't, because there are, of course, internal and external forces operating on our organizations every day. And the internal ones we can do something about. The external ones we might be able to influence, but we certainly can't change. So the investigation piece tells us whether we can or cannot do something about it. And if we can't do something about it, maybe as part of the feedback loop, we have to change our organization's planning and direction and go from there. However, the other offshoot is if there is something we can do something about it, we do it. Okay, the corrective action box. So are there any questions on that? Like I said, I'm anticipating that this is not necessarily new information for everyone, but at least it coalesces in one place, the process that most of us all go through. Okay, now who's responsible for this? Okay, planning and control our management activities. All right. Now, again, depending on the size of the organization and the involvement of the board in the day-to-day operations, very smaller organizations where the board is the management, of course, this is their task. They end up wearing two hats. They have to actually do some of the planning and control, and they actually have to approve it. But generally, you're going to have a CEO, or you're going to have somebody that the board has hired to do the work, and the planning and control are their activities. Okay, now it's not that the board is not involved. Okay, they do have a fiduciary responsibility, so they do have to keep an eye on what's going on, but it's more from the point of view of performance management of the person in the CEO chair than it is actually developing the budget and doing all those things in the first place. So the planning and control and the budgeting process is primarily a management responsibility. Now, we do that in response to what the board wants us to do. Okay. And again, the boards monitor the fiduciary as part of their fiduciary responsibilities. Now, it's important to note that differentiation. Okay. Because usually where you run into problems in any organization is when the board is doing things that management should do, or the other way around, and the two are conflicting with one another. So when we're looking at planning, control, and budgets, actually the development of them and all of those things is the responsibility of the management group. Providing direction to that management group at a strategic level is the responsibility of the board. And the board does have an oversight responsibility to make sure that the people that they've hired to do what they want them to do are actually doing it. So are there any questions on that? Now, I am laying a bit of a foundation for something I'm going to talk about a little later, is so what happens if there's problems. But anyway, that it's very important that people recognize the two different responsibilities for the board and the CEO. Now, the reporting system, which is basically what we talked about last time, has to provide the information to the management people then so that they actually get what they're looking for. Now we're switching gears here a little bit, okay? The reporting system here is going to be doing management reports, which are not as subject to generally accepted accounting principles as the financial reporting that we were talking about a week before. There we do have to abide by, for lack of a better word, some rules and guidelines so that everybody is on the same page. We all know that if this particular number is in this particular place, it means X. But when we're talking about the internal reporting system, which is what we're talking about here now, in terms of actually looking at how the budget, how we're doing from an actual to a budget point of view, we don't have to necessarily stick to an actual financial report to do it. And that's what I'm trying to get to with this particular slide. Okay, we can have a subset of the financial statements go to each individual operating person, or we can have a combination of statistical reporting and financial reporting all at the same time. So you might have a report that says we got $10,000 in donations, and it also was actually 4,000 actual donations. You would never see the unit number of 4,000 actual donations on a financial statement. But in a management report that's coming back to people, you can see that kind of statistical information as well as the actual information on the finances as well. It could be anything from number of clients served to numbers of donations actually received to numbers is what it's talking about here, but it's non-financial numbers that we're talking about. And when you're doing the budget process, often as not, it's more than just the financial piece, okay? You end up actually budgeting for a certain number of hours, or you end up budgeting for a certain number of items to happen over a particular time frame, a certain number of fundraising events to happen, whatever it happens to be. So you end up having almost two separate pieces here. Okay, you have the financial piece and you have the statistical piece, and both are important to the individuals, particularly when we get into that investigation phase that I was talking about earlier. I can look at a financial statement compared to a budget number and say, well, there's a variance of $15,000 on this particular number. Okay, but why? Okay, when I go back into it, I now actually likely will go away from the financial information and look more at that statistical side and say, well, okay, we had one less or two less days of reporting in here, or we had only 3,000 donations when we expected 4,000, or if it's the other way, we overspent on salaries by $10,000. Why? Well, we had a whole bunch of overtime. Why did we have a whole bunch of overtime? Okay, so the statistical side of the management report that you're going to get back here is going to be much, much more important, or maybe not more important, but probably equally as important as the actual number itself. So is there any questions on this? What I'm trying to emphasize here is that the reporting system has to come back now to help the decision makers make the decisions they need to make. So it's going to be financial information, and it's likely also going to be statistical information. And your budget could also have some of those statistical things built into it. Okay, seeing none, we've got three types of budgets out there. We've got an operating budget, which is the day-to-day operations, and capital budget, which is the purchase and sale and retirement investments of long-term assets. I took that straight out of a textbook, but anyway, it's basically all of the things that you buy that have physical substance. It's your building, it's your car, it's your desk, it's your computer, it's whatever it happens to be. Okay. Now, the one that most people, I shouldn't say most, I'm generalizing, okay? But one that's often missed or is not looked at as often in a lot of organizations, and sometimes it's fine because they don't need to, okay, is cash, all right? But I know in my own organization, we look at this even significantly. And the reason is because the not-for-profit portion of CAA, well, actually, truly the profit side, we look at it as well. And the reason is because we're living in business, we're operating in businesses that are cyclical, okay? But if I look just at the not-for-profit side, we're looking at the club organizations. So we do a lot of towing in January and February. So I have money going out of here in January and February, a little bit like water through a strainer. But I end up having to, in the summertime, I don't, okay? We actually make a profit in a not-for-profit during probably from about the middle of May through the end of September, okay? We make money. We end up having more membership money coming in than we have money going out. But that's okay because I know that I'm going to have to spend it in December, January, and February. So I have to do a little bit of planning for cash flow fluctuations. And the cash budget is the one that we're not usually as familiar with, particularly in the smaller organizations. We do it. We have to watch our cash flow. You know, if we don't have the money, we can't do something, but we don't necessarily formalize it into a budget. Now, just to actually talk off about this, I'm going to talk about each one of these in detail, but the operating budget is dealing with things on your income statement. Your capital and cash budgets are dealing with things on your statement of financial position, otherwise known as the balance sheet. Now, before we launch into each one of these on a separate basis, are there any questions? Okay, a typical operating budget, okay, it's going to be a pro forma income statement supported by a bunch of detailed schedules. And the detailed schedules are going to be what you do from programs, okay? So you're going to have a revenue budget, and it may include sales if you actually sell something. And it's developed from a revenue or a sales forecast. So what you have to do is go in and look at each one of your revenue lines at a program by program basis or on a whole, depends on how the money's coming in. Because I talked a little bit about this when I talked about income statements, where you had an income statement that was a summary one, and you had a supporting schedule for what to actually run the company. And the supporting schedules were program by program and or operation by operation, whatever it happens to be. So your budget is going to mirror that. You're going to actually have to develop the budget at the most granular level that you can in the organization. So what happens here is you're going to have program budgets, all right? It's developed in part from the revenue budget, often as not when we have our program budget in terms of expenses is going to be governed by how much revenue we can particularly think we can particularly get for that particular program. And we're always $1 short and a day late. But at the end of the day, once we've done a revenue forecast, we can actually go at the expenses. Now, that may seem a little counterintuitive to people because you know what? It's very easy to budget the, I shouldn't say very easy. It's easier to budget the expenses often than it is the revenue, but it is the revenue that drives the amount of expenses that we can actually do. Okay. And the program budget is going to actually have in it, materials for that, labor, any overhead, which completely, is depreciation and occupancy costs. It may include cost of goods sold if you have sales in a particular program. And I'm just harking back to my old days when I worked for Canadian National Institute for the Blind. They did have a little store because a lot of the, back then, it's not so much anymore, but back then, 25, 30 years ago, a lot of the products that the people that had visual impairments needed were not available widely. So they actually ran a little store that ran basically at a break-even level to provide these for people. Okay. And then you may also have an administrative expense budget, or what I call a common cost budget or a common revenue budget, things that are not assigned to a specific program. And myself, again, I can use my own organization as an example. We have a head office budget that I'm charged with actually putting together and making. And it includes the expenses for the board. It includes the expenses for the CEO and his offices. It includes some of the HR stuff that we do in payroll. It includes the IT and the accounting departments. Okay. These are all things that are not program specific, but have to have a budget for them somewhere. So is there any questions on what a typical operating budget would include? Okay, your cash budget, of course, is balance sheet item and it's long-term physical assets usually, and it's developed from a forecast of needs. And it may include some financing, but that's usually in your cash budget because, of course, we have to figure out how we're going to pay for some of this stuff. All right. And this one, again, is fairly straightforward from a point of view of the expense side. We can usually figure out what it's going to get, a reasonably good estimate of what it's going to cost us to buy a desk or buy a computer. It's as simple as going online and looking in some cases. But the actual how we're going to pay for it side becomes a little bit more problematic. And I know our budget, I have to, when I do our budget and we do the capital items side, I have to actually say in there how we're going to actually finance it. Now, some of that is as simple as through day-to-day cash flow. So for example, when we buy a tow truck, I don't go out and look for donations for a tow truck. But I do know that when I was working for Canadian National Institute for the Blind, if I was looking for a car for our staff people to go around and visit people in the country, then I would have to go out and I would have, if I was under the organization I'm in right now, I would actually have to say where I'm going to get the major donations to fund that vehicle. So that's what I'm talking about. Sometimes in these, you have to actually have the capital budget with the financing. Are there any questions on that one? Okay, cash budget. Okay, it's mostly about timing. It's about listing each month of the year and saying, I'm going to get this many cash receipts and I'm going to have this many cash disbursements. And it's about financing if we need to do that. Okay, and by financing, I mean loans, anything like that. Could be just as simple as overdraft protection on your bank account. But nevertheless, it's there. Okay. And because if the cash receipts are less than the cash disbursements in any given month, unless I have a significant reserve built up, I may need to actually dip into overdraft protection for a couple of months and then come back out. And it also includes, as I was talking about in the previous budget, anything where we're looking at long-term assets being purchased. So I may have a grant, for example, to do something, And I'm going to have to look at the timing of this because whatever I'm spending the money on the grant for, I'm likely going to spend the money before I get the actual grant money back. So I'm going to have to figure out where I'm going to get the cash to actually do whatever it is. The grant money I may get some upfront, I may not. I mean, it depends on the structure of the grant, obviously. But often as not, I'm going to expend the money before the government sends me a check, or more likely a direct deposit these days. But nevertheless, I have to figure out how I'm going to get the cash disbursement, because I have to pay the supplier before I actually get the actual money to pay for what I'm looking at. And that's what the cash budget is about. And it gives you some idea of where you're going to get this money from and what you're going to do. So are there any questions on that, guy? Okay, how do we actually go about doing this? All right. Now, as I said earlier, budgets are developed at a high level of detail, very high level of detail. It's usually each functional line in every program. So you have a line for salaries, you have a line for benefits, you have a line for program costs, you may have occupancy costs of that particular program if they aren't all under one roof and using the occupancy cost as a general cost. But basically, if you have a schedule in your financial statements that I was talking about last time, you will have a budget line for every line in those financial statements and every line in those schedules. So you do this at the most detailed level that you look at. Now, generally, we look at a couple of years of prior data and forecast the current year and then try to determine what's going to happen. Now, there's the old saying out there that past performance does not necessarily indicate future performance, but it's still the best we've got in terms of looking what's been going on and what we're going to have. And then, of course, we build in any changes that we know about. So if we've got a new program starting, or if we've got something that's changing, a program disappearing, or whatever it happens to be. Okay, so we're basically going to look at this and say we're going to have to do a number and maybe a statistical number. Okay, keep in mind that there may be a number of hours attached, or there may be something like that attached to this for every line that we have in our financial statements. Okay, we're going to look at our past history to try and forecast what we're going to have for the next year or two, and we'll build in any changes that we know about at the time. And even though we're going to build this at the most granular level, we need it at the most granular level for us to run the company. Again, the control side of the budget, as well as the planning side, really, but more towards the control side. Okay. The board's likely going to want it summarized at the same level as they see at a financial statement level ongoing. So if they see a single page financial statement every month, then they're probably going to want a single page budget. But I wouldn't go to my board without having all of the schedules and everything underneath and being able to produce them. Because if there's always going to be that guy on the board, and I might be one of them if I was on your board, that says, okay, your budget for this particular program has changed 20%. Okay, why? So then you can bring out the schedule. Okay, now I have a question here, so just let me have a quick read here. Okay, so it's about not having the prior year data on a program that's out there. Well, okay, on those, I would break my rule and basically say, all right, let's look at what we want. Basically, what you have to do is say, okay, what are we going to do? Okay, and what resources are we going to need to do it? Now that resources has two pieces, okay? One is the revenue and one is the expenses. Now here I would probably look at the expense side first from the point of view of saying, okay, this is what we want to accomplish. How are we going to go about doing it? Okay, so if we know how we're going to do it, it's going to require this many people, it's going to require this much space, it's going to require this much of whatever it happens to be. Now you go out, and if you don't have anything for that particular program, you do have experience in other programs usually. So you can probably draw on some of your other programs and say, okay, if we require 150 square feet of space, it normally costs me X amount of dollars per square foot for program X over in the corner because we're renting an office to do that. And if I have to rent 150 square feet more, it's going to cost me this much money. And you basically build it granularly, one piece at a time. I'm going to have one person looking after that. I have to pay $35,000 or $40,000 a year for that person. Generally, in other programs, my benefit cost has been 10% above and beyond that, or 15% above and beyond that. So you can go through and draw on your experience from other areas. Now, when you're starting a program, the revenue is going to be the harder part. But if you do have a government grant or something to start a program, you're going to know that for sure. Okay. Or you intend to apply for one because there's one out there that you qualify for. Okay. So the revenue side is going to be a little trickier, but you can go from there. Now, I don't know if I've answered the question, but basically all you can do is basically look at what you want to do and draw information from other programs as to what it has cost you to do various things and what revenues you've been able to generate in other areas, so that you can figure out some sort of an estimate of what it was going to cost you. And is it going to be a little bit, well, you saw my original slide, right? Okay. If I start doing my budget, sometimes my best estimate is going to be done by dead reckoning. Where's my dice? Okay. And go from there. But that's how I would go about it. I would go about looking at saying, what do I need to do what I need to do? And then go to other programs and other areas of my organization and say, if I was doing the same thing there, what would it cost me and where would I get the money? Now I've got a couple of slides here from the last one. Okay. At that granular level, you're going to have all of the accounts you're going to need, and you need the chart of accounts to do it. And you're probably going to budget at most of your income statement ones, and you're going to budget a few of your balance sheet ones as well. Now, there's a question here about a bank account be established with an overdraft. That's up to you and your level of risk at the board. Okay. I do it routinely. All right. Because I never know. Well, again, I'm working in an area where I've got a lot of cyclical things going on. If you know that some organizations are A, small enough, or B, steady enough that they don't need to look at a lot of these things. Okay, they know they're getting this much income every month because they're operating off grants and not much else. So they know they're going to get X number of dollars every month. So they have a fairly static operation underneath of it. They know they're going to have to pay this many people. They know they're going to have this much rent. They're going to have this much utilities, whatever else. So it's basically pretty much a carbon copy all the way across. Okay. Now it's not identical. It may even be a little bit cyclical, but you still know it. Okay. So if you know that you're not likely going to need overdraft protection, then you don't put it in there. Okay. But I routinely do it on my current account where I'm writing checks from, just in case something happens. And yeah, the banks, they don't charge you to set it up usually. Depends on your banking arrangements, but they don't charge you to actually have it there. Okay. They'll just look at your assets and say, okay, they have this, and they'll determine from your other assets what size your overdraft can be. But that's the extent of it. If you never dip into it, you never pay. Once you dip into it, you pay interest. So again, I don't know that that answers the question 100%, but it's going to be more dependent on your tolerance for a level of risk, and go from there. If it doesn't cost you anything to set it up, put it on there. Okay, you've got it. Okay. So again, like I said, we've got this chart of accounts here that has every income statement account and every balance sheet account that we need, and go from there. Okay, now there's a question out here in terms of an accepted percentage of increase to use to calculate standing operating expenses, utilities, contract services. What I usually use is the CPI rate, if I can get my mitts on it. Okay. I also keep an eye on news flashes. So for example, if the government of Saskatchewan is looking at a rate increase from SaskPower through their utilities board of 4%, well, I already know that. Okay. Now, I'm not necessarily going to know that when I go in there. So then from there, I go with the rate of inflation that's going on at this particular time. Or on salaries or things like that, I'll use something that I can try and get from a payroll, not a payroll, but a human resources website. I'll go out there and look for trends and subscribe to a couple of these HR site services that kind of look at trends across the country that tell me what's happening in various different businesses. Now, they're not great for not-for-profits because they don't do a lot of it, but they do some. And whether we like it or not, even in the not-for-profit sector, people work for us for other reasons than money a lot of the time. But having said that, they still have to eat. So we do have to keep an eye on what's going on in other industries. So again, usually you're looking at a level of inflation of 1 or 2% and go from there. Again, hopefully I've answered the question. Okay, let's have a look at a couple of quick examples here. There, that's where I want to be. Okay, so this is not particularly anything great. I just pulled this in. It's nothing here, but I'm just looking at an operating program budget. Okay, so this is program 1. I've got 19 and 20. 2021 would be this year. And then 2022 is my actual budget year. Okay, so I'm looking at this and I got $1,000 here, 1,025. Well, we're back down a little in 2021. Well, maybe 1,100 is not going to be too bad. Okay, and my grant, the government's already told me it's going to be lower, so that's what I got to go with. You know, you're doing a lot of eyeball work here. Okay, and you're looking at your past performance and saying this is what it's going to be. And I can't remember, but I think I put this up 1.5 or 2% here. But I'm just basically going through and looking at all my revenue lines and all my program lines. And if I have specific things at the program level, okay, rent, utilities, and depreciation. Now, this is what I'm talking about, specific things that I can identify that belong only to this program. I will budget these overhead costs at that level. So these guys may have this program may have a vehicle that they use, so we can put the depreciation for that particular vehicle into that program because nobody else uses it. Now we would do the same thing with whatever other program we have. Okay, so this one's a little different. As you can see, it's got a bigger grant, has more people involved, but it's exactly the same thing, just on a different scale. And then I might have an admin and general one. And as you can see, I get a lot of general donations here. And at the end of the day, I end up with a total that basically says, okay, this is my revenues that year. This is my expenses. As you can see, we lost a little money that year. Okay, this year we made a little. This year we're projecting that we might still make some. And our budget has an actual deficit in it. Now, I would not likely, I did that deliberately because I wanted to remind myself to have a talking point here. Chances are pretty good the direction from your board is not going to be a negative number on your budget. However, having said that, the not-for-profit world, these guys have built some money up over a couple of years. So maybe the board is going to say, well, we'll take a little bit of this reserve money because back here, I did a grant that was going down. So we'll deficit finance for 1 year, basically equal to the amount of that grant going down until we figure out what's going to happen. So that's the reason I did that the way I did. So are there any questions on what kind of an operating budget would look like? Okay, capital budget, again, program one or capital item one, it could be divided by program. It could be anything. You know, you're going to have funding if you need it. We got a grant from a foundation. All right. And the cost of the item, including freight, duty, taxes, all of those sorts of things. Okay. Now here's where we get into some of the statistical use on it. Okay. It's going to have whatever we're buying here is going to have an expected useful life of 6 years, salvage value. So that means that my depreciation on a straight line basis is going to be $7,300 a year on whatever this happens to be. So now I'm going to have to make sure that I go back to my program one budget and make sure that I've increased the depreciation by $7,300. Okay, no, I didn't, Lynn, sorry. We'll go back here. Okay, what I'm looking at here, okay, is a net program cost. If it's negative, yes, okay, all right, yes. I did say that backwards, I'm sorry. Okay, the negative is a profit and the deficit is here. So in this budget, we've gone to a slight profit, okay, rather than a negative. You know, you could do it either way, okay? I've done it this way in this particular example as a net program cost. If it's negative, then the net program cost is maybe a little counterintuitive. Before I send these slides to Lynn, I'll maybe reverse that. But the talking point is still there. And basically, you can have a point where you have built up some reserve funds. You could have a point where your budget is going to have to go into a deficit. And the board of directors says that's just fine. But I don't know. Most of the time, I don't want to go to my board with a negative number. Okay. And so what I'll do is before I send you these slides, I'll switch this so that they end up with a more intuitive thing here. Okay, any other questions on that? Okay. As I say here, okay, the capital budget, we've got how we're funding it, how we've got it here, okay, but the key talking point on this one was to remember to go back and change your depreciation number rather than just look at what it was last year and keep going, okay? Now the cash budget, as I said, looks something like this. So what we've got here is we've got various amounts of revenue coming in and various amounts of expenses. And what I was trying to illustrate here was the cyclical nature of revenue, particularly in places where you get a lot of donations. All right. It was and is probably still typical that you get a lot of donations around Christmas time if you're in the donation business. All right. Canadians as a whole are more generous at that time of the year for whatever reason. And it could be as simple as taxes. Okay, they need the donation to get their taxes down. Anyway, we get a lot of money. All right. So what happens here is there are times in the year where we don't have, you know, the grants. Maybe what I've got in here is a steady grant and then one that comes in quarterly. Okay, which is also a typical thing. So we're going to end up expending wages through here, even for something that happens that we get the money quarterly. Okay, so what I was trying to say earlier and illustrate with this is that I could have expenses that are kind of, you know, as you can see, they're not too far. Okay, here is fairly large because I got the one big capital item. But most of the time you can see my expenses are running 175 to 185, maybe 190. Okay. You know, my expenses are relatively easy to predict and relatively going there. Okay, now what this is showing me here, okay, and Terry, I'll get to your question in a sec to just make sure, but what this is showing me here is in January, I'm not going to have enough money to cover off what I actually have to expend. Okay, so I'm going to have net cash out of $25,000. I'm going to spend $185,000, but all that's going to hit my bank account is here. Okay, So I may have to dip into my line of credit. Okay, and assuming I have nothing else, which is what this does, I'm now minus 25,000. Same thing happens in February. It actually gets a little worse. Okay, I need another 34,000. I'm 59,000 in the hole. Okay, in March, I get the quarterly grant coming in and donations. I have a fundraiser in March, so I get more donations, things like that. So here, I'm going to have 35,000 more. So my line of credit drops. Okay, I have the ability now to repay some of the 59,000 that I have actually dipped into it for. So it drops to 24. April, the wheels fall off again, mainly because I didn't get or I bought the capital item. Okay, and my timing goes all crazy here. Okay, but through the summer, the next month in May, okay, I get a bunch of stuff in. As I said, I get the grant money here to cover off the capital item. So again, my cash is higher for a couple of months, so I pay that $94,000 down. July comes along, donations dry up. Same thing with August. Okay, so we're back into the line of credit. Okay, and then along comes December, and I get enough money that I've paid the whole thing off so that I go into the following year with a zero cash balance. In other words, I'm basically there. Now, I showed this one deliberately at a zero at the end so that that's what you can see from a cash budget point of view. Your chances are pretty good your actual bank account is going to have money in it. Okay. Nobody budgets to be zero at the end of the year. You go from there. Okay. Now, what I think we've got a question here. It says, does it mean a deficit should be expected and budgeted for annually? If we're expecting a deficit, okay, because we've lost a grant or some dang thing, okay, and we know we've got some reserve, we want to carry the program on. The board has made the decision that we want to make the program carry on, okay, then we basically then have to say, okay, where are we going to fund this other than that? And it may take us a bit of time before we go out to a foundation or we get donations or we get whatever it happens to be. So for a short period of time, maybe 1 year, okay, we may have to deficit finance that program, and it may be a big enough deficit that it puts our whole budget into deficit. Okay, now as long as you're doing that from the point of view that the board of directors knows what's going on, and you basically go through the process of trying to find out what's going on, because you're going to reevaluate this in a year. Okay, I was either able to find some funding and we'll be able to carry the program on, or I was not, and we either have to deficit fund it another year or we have to can it. Okay, but what you're looking at when you're presenting to your board is going to be an annual budget. What you're looking at here from a cash budget is what's actually happening with your bank account. Okay, so when we're going back to here, the board is going to see this, and maybe it's got a deficit in it. Okay, and the board is happy with that. They're fine. Okay, because of whatever reason. Okay, and you show that on an annual basis. All right, same thing with this particular admin program here. Okay, we're showing that it's making money. We're showing that this program here actually is in a deficit because we got a net program cost here. Okay, so there you go. All right, so you are showing the deficits of whatever you're doing on an annual basis, usually in your budget. But here, this is what's talking about what's going on in your bank account. And the reason I do this is because this is not absolutely typical of what goes on, but I end up going through money crazily here. So we end up dipping into our line of credit usually by the end of March. We did this year. February was a zoo. Okay, so we don't have enough cash to cut. Well, we do. Actually, I could pay it off. I've got other reserve funds, but I don't want to touch those. Okay, so I'm going to have my bank account actually in a negative balance, but I need to know this because I have to make sure that I've got enough overdraft protection to get to 95,000 or 99,000 in this case. Okay, and I also have to know that I'm going to pay interest on these numbers, and I have to build that into my operating budget. Okay. Now, get grants for specific projects. Would that be listed in cash inflows? It makes up a year. Yes, this is the organization as a whole. Okay, so even though you may go back here and have an operating where you get a specific grant for a specific program, okay, you're doing your cash budget at the organization as a whole. Okay, so you're going to see that your salaries and benefits for the whole organization. Now, this does not preclude you from doing a cash budget on an individual program by program basis. Okay, all we're trying to get at with the cash budget is to say, look, because this could get significantly out of hand here. All right, if we only had $50,000 worth of overdraft protection, there's 2 or 3 months here where we could be, or 4 or 5 months actually, where we could be in significant trouble. Okay, so this is a planning document to say, okay, I'm looking at my cash flows, either program by program or on the organization as a whole, and I'm going to have to be talking to my friendly banker to the tune of up to $100,000 here by the end of September, knowing that by the end of December, I'll be able to pay it all back. And of course, it has ramifications on interest costs and things like that in the actual budget. Are there any other further questions on these things? Now, after approval, okay. Now, this is where I want to talk about a little bit about some of the things that happen to us as budgets. Okay, budgets, like our budget this year, it would normally be approved in June, and our year end is the end of July. So, and by the way, that's the world's worst time to have a year end. I don't know why I cannot get my board of directors to change it, but I have a heck of a time trying to get people to get things done when they're on holidays. Anyway, that aside, okay, the budgets are set near the end of the year and they're for a full year out. Now, as I said earlier, when I was sitting at my desk a year and a half ago, even a year ago, okay, or a year and a couple of months, by that time I knew in January that there was things going on in China, but I really, looking at the news sites, well, so what? Okay, I've seen SARS before, it didn't hurt us that bad. Well, this one's been a little worse than that. So anyway, things are going to change. All right. Now, in the industry, we use something called a flexible budget, and it looks at sales prices and unit costs and adjusts things up and down. And basically, you try and control it at a unit basis. Now, that's not always applicable in many not-for-profits, but it is used in the not-for-profit sector. Okay. And I'm a perfect example. When I look at towing every year in December, January, February, and even into March, I know that we're going to go through a lot of towing money. And basically this February, I had a number in the budget for towing of a little over $500,000. And they blew through it in about the first week and a half. Okay. No, it wasn't quite that bad. But anyway, they did blow through it. They ended up spending closer to $750,000. Okay, so now I go back to, and I'm going to talk more about this in a few minutes in variances, but I go back to the vice president of automotive and say, well, look, what's the matter with you? You spent $250,000 more on your budget. Well, there's nothing he could have done about that. Okay, it's part of the nature of what we do at CAA. We're an insurance type organization because we are going to give you road service based on when you demand it, okay? And what that demand is going to be next January, February, I have no idea. We could have a Chinook come through and I won't have to spend any money on towing at all, or we could have another cold one and I'll have to spend all kinds. So to try and do the performance budget for this person, what we do is we say, okay, it costs us on average X number of dollars to tow a vehicle. Okay. And it's split in half. So it's basically so much to hook up and so much per kilometer. But basically it costs me about 100 to 125 bucks to tow a vehicle. So now I go back and I look at that unit cost and say, okay, you did, what did they do? They probably did 40,000 tows and boosts and everything else. But I mean, they probably did 40,000 tows in February. And so now I look at what they spent on towing And did they spend between $100 to $125 on each one? If the answer is yes, then it's a volume difference and there's nothing we can do about it. Okay. But, okay, if he spent $140 on tows and we were expecting to only spend 125, I now have to go back and look at why. Okay, were we towing people farther? Was it costing us more for the actual tows? Because we only have a fleet in Regina. We use contractors all around the province. You know, I have to go back. Well, it's not the royal eye. I mean, it would be me and the vice president of automotive. We're going to have to look at that number because either A, we have to get more out of our membership price to cover it if it's not going to change, or we have to do a better job of negotiating our contracts, or we have to, you know, change something. Okay. So we have to go back and look at it. So that flexible budgeting concept is where you take a unit price and look at that because your budget is going to go all over the place. So even though he spent 750,000 on towing instead of 500,000, it was 500, you know, he probably, we based the 500,000 on say 30,000 tows or 35,000 tows and he did 40,000. Well, and I got to expect the number to go up. Then my only control is to be able to look at what it cost me per tow to see if they're actually in line. And then I go back and look at that volume thing. And that's the concept of flexible budgeting. Now that doesn't happen a lot in not-for-profits. Mostly of what we do is we get a grant or we get donations and we do whatever it is we do. And we don't fluctuate a lot based like that. Okay, so I don't want to spend a lot of time on that concept, but it's basically something that can be done. So what do you do if you can't do that kind of flexibility? Okay, and even us with a flexible budget like that, we still have to live within our means. Okay, it doesn't mean that we can just go spending money like drunken sailors here. Okay. Now, if you can't shift resources from one program to another, revenue or expenses, okay, you're in trouble. So what I always made sure when, and I even do it today, okay, on parts of our organization, our board, I've got my president and CEO to have built into the policy a series of approval levels. So we can actually move money around. So we'll budget for something now in June, but a year from now, I don't need that money in that place, but I need it somewhere else. At a management level, they can move around X number of dollars. At my level, I can move around a little more, approve somebody to move a little more. The CEO can do up to $100,000, and anything over $100,000 that we're going to shift between programs is going to go right back to the board for approval. So we built in that we can move around a certain amount of resources to react to things, and be it people or, you know, money and expenses or revenues, we can move it around so that we can do that. And we did it at various levels to do that. Now, as I said, we, even with that, get to a point where we have some interim budget revisions that we end up having approved to the board, most of the time on the capital side, but nevertheless, even on the operating side. Okay. And if you do have a deficit that's coming at you because of COVID-19 or something coming along, then make sure that there's some way of funding it. Either you've got reserve funds and your board is aware of it. And, you know, there's no, life is bad for a CEO when there's a surprised board. It just doesn't go well. So try and work in what you can. Okay. So is there any questions to this point before we look a little bit about on variances in the last 10 minutes or so? Okay, budget template. I'll see what I can dig up and send it to Lynn and go from there. Okay. I'll see what I can put together. Lynn, that may take me a day or two, but I'll get it to you at some point. Okay, back to control. How do we know? All right. Well, what we're going to do is we're going to take our actual results, we're going to compare them to our budgeted results, and we're going to get an actual budget variance thing here going on. So when you can see here, the revenues, the budgeted, so we had a 62,000 unfavorable budget. We had variable costs. They were actually better. So even though, so what's happened here is we knew we were not going to make our revenue target, so we were able to cut back on a few things. Okay, so we did. Okay, so we got a favorable budget there. So our margin when we're done here between the variable costs, and this could be program margin, whatever you want, is that it's still unfavorable, okay, compared to what our budget was. And we got a certain amount of fixed costs. So our operating income is a negative here, and our operating budget was actually to be a positive. So of course we're in the ditch, 18,400. Now, that's a typical variance report. I showed this a little bit last time when I was talking about it on the financial statements. It can also have in it, I didn't put it in here, but it can also have in it statistical information. So for example, it could have things on these variable costs. So we could go back and look at the number of staff hours, or we could look at things like that. Because really this variance being favorable doesn't tell me very much, okay? It tells me a place to look. That's all it tells me to do. So if I know I should look at the variable costs, okay, fine. How was I able to cut this back? Now you may know this, okay, but your board won't. So you'll get the question on the board, why did you, why is the income down, and what were you able to do to react to it to get your 43,000 favorable? And you're going to have to be able to tell them that. So at least in your back pocket, you better know that you cut some staff hours or whatever you did over here. And up here, it was because we didn't get a grant, or we didn't get certain donations, or a fundraiser got canceled or something, okay? And your fixed costs, this is of course operating, you know, rent, heat, light, power, that kind of thing. You know, they tend to be exactly that, okay? They're going to happen if you open the door. So we know what's happening. Now we know we got an actual deficit coming at us here. We had budgeted for to have a little bit of a surplus, okay, but we're behind. And then of course, the next question that's going to happen to you, next thing that's going to happen to you is okay, what are you going to do about it? And that's why I'm going for the statistical information things here behind some of these numbers. So is there any questions on that? Okay, now unfavorable variance, okay, actual amount paid or used is greater than budgeted, okay, and the impact on the bottom line is negative, okay. Favorable variance and amount paid is used is less than budgeted. The impact on the bottom line is going to be positive. From a revenue perspective, they're the opposite way around. Favorable ones, you have gotten more money, and go from there. Yeah, and there's a question on, yes, fixed costs are overhead expenses, admin, that kind of thing. It's I put them in as fixed there simply because I wanted to emphasize that they don't change very much. Okay, so if I'm renting space, and you know, I'm going to have a Sask power bill, I'm going to have a water bill, I'm going to have a Sask energy bill. You know, I'm going to have to pay the rent to the landlord. I might have to pay property taxes. I might own the building, so I might have to do a bit of maintenance. They're the types of things that are basically there just for you to open the door and have your program go. So hopefully that answers the questions. Okay. Okay. Now, what we're going to do is, as I said, we're going to take the actual costs and revenues and compare them to the expected costs or revenues. So how do we do that? Okay. The key questions we're going to ask here are these four. Okay. Why is the actual performance be different from the expected performance? Why is it out there? What's triggering a decision to investigate? By that I mean, you don't investigate absolutely every cotton picking thing. Okay, if I'm out $5, I don't care. Okay, if I'm out 500, I start to care. Or if I'm out 5,000, I really care. Okay, so that's what we're talking about, what triggering the decision to investigate, and is it significant or not? Okay, and what are my consequences of not meeting the budget? Okay, and now I don't mean I'm going to get canned in the morning. Well, that might happen. But the other thing here is, okay, what do I have to do? All right, if I'm not meeting my budget, what do I have to adjust? Okay, do we have to adjust our staffing levels? Do we have to change our space requirements? Do we have to go out and try and run another fundraiser? Do we have to do this, that, or the other thing? Okay, so what we're looking at here is trying to find out, trying to answer all of these questions, because the variance, as I said back here, points me to a problem or points me to something good. It doesn't say anything more than that. Okay, so we have to look at why it might be differing. Okay, we have to look at what triggers us to actually go and look for it, because we don't want to look at absolutely every last penny. Maybe you have to, but I mean, don't necessarily do that, which is, of course, is the variance significant? And are there consequences? So even though we may have a variance, okay, it may not have any consequences at the present time. But I'll tell you, 9 times out of 10, if not 99, not more than that, 99 out of 100, they usually do. Okay, we usually, it could be short term, all right, you know, something happened that the grant got delayed, so we're not going to get it next month. Well, okay, so then there's a variance this month, but do I care? No. Okay, but why? Because it's going to correct itself next month. All right, so there's no consequences in that sense. Okay, but if it's going to be an ongoing problem, then we will have to fix it. So are there any questions on that? Okay, now again, when you're looking at variances, you want to look at these two things. Okay, it's a concept called manage it by exception. And materiality, what we mean is it a material difference? So do I go after the guy for 10 cents? No, I don't. Do I go after him for 10 grand? Yes, I do. Okay. The other thing you want to look at is cost versus benefit. The variance might be there, but again, if it's going to cost me way more to find it or change it than what I'm actually having to look at in terms of the variance, then I won't worry about it. Okay. Now, what is the impact on the bottom line? Okay, and most often as not, most boards of directors are going to be investing in variances. They're going to have some sort of a rule for you to go after these things. Okay, so plus or minus $5,000 or 25% of expected cost or something like that. Okay, they're going to have some rule out there. Now, this rule is going to change depending on the size of the organization. So obviously, if you have a, you know, $20 million organization, investing a variance of $5,000 is probably going to be good enough. But if you have a $200,000 organization, $500,000 is already a significant sum. Okay, we're looking at 2.5%. So we probably are going to investigate something over 500. Okay. But make sure your board has something out there that gives you direction as to what you want to do. The other thing you want to make sure is you, particularly if you're not a one-person shop and you're supervising several people, is to be cognizant of the controllability of this thing. Now, I was talking about that earlier when I was talking about the towing. There was no sense in me going to the guy and saying, look, you're over 250,000 in your towing, because he can't control it. What he can control is the cost per tow. Okay, so I'll go after him for that, but I won't go after him from the point of view of him being 250,000 over budget. As it happens, January was actually not that bad this year. So on the 3 months, January, February, March, we're actually about the same as last year. So it worked out, but we still had to look at it and make sure, because we could have had $250,000 that we had to find between the end of February and the end of July. Okay. And the final concept that I wanted to put up there is responsibility accounting. When you're looking at variances and you're looking at program costs and everything else, okay, identify who controls what, okay? Identify the causes, identify the appropriate corrective actions, and make sure it feeds back into your future planning for your budget. So is this going to reoccur? So we have to adjust our budget for next year, that kind of thing. Now, we haven't left a lot of time for questions, but we have done it sort of in between. So with 3 minutes left, hopefully I've answered a few questions for you. I will give these slides to Lynn, and there was a question on a template. I'll see what I can dig up. It may take me a day or two, but I will see what I can dig up and get that to Lynn as well. And hopefully it's given you a little bit of insight into how I do things anyway, be good, bad, or indifferent. And hopefully it gives you something you can work with. Okay, Lynn, back to you. Give you 3 minutes, whether you like it or not.
Well, thank you so much, Dave. As usual, you have managed to cram a lot of information, really good information into a short period of time. I think you called this the Reader's Digest condensed version, which is really, really, really condensed, right? Because you teach full semesters on all of this, right?
Yep.
So hopefully this is enough information that people will get like a few little tidbits they can take back to their workplaces. And I would just like to remind everybody that session 3 in the series is taking place a couple of weeks from now. So Tuesday, April 27th. I've got the link in the chat there for you. Hopefully we'll see some of you back for that session. And as always, any ideas that you may have for programming that would serve the community well, please let me know. We're always interested in making sure whatever we offer in terms of training is something that is of benefit to the community. So we always welcome that input. So I'm gonna say adios, goodbye to everybody, and hopefully we'll see some of you again in a few weeks. And if you're in the prairies, enjoy our kind of like little last hurrah with winter.
Yeah.
And we'll talk to you soon.
You may have heard the expression, the age of chivalry. We've entered the age of shovelry. On that sad note, we can end the meeting, Lynn.
Okay, well, good rest of your week, everybody, and thanks for joining us.